What did you make out of what we saw this week? There was a lot of back and forth about where inflation's going and therefore what the Fed's going to do.
Yeah, so I think what we saw this week, kind of a continuation of last week, is understanding and trying to break down what are the expectations really for rates in terms of, are rates going to be higher for longer? I think the market is also trying to assess, last week we saw this in terms of the additional supply in terms of U.S. government debt. We saw what the Bank of Japan did as well. And so trying to figure out what are the expectations for both growth and inflation. And I think there's a little bit of volatility there. So that, I think, we'll see some volatility within the month of August. But in reality, I do think, just given the conservative positioning that we've seen from investors and a lot of cash on the sidelines, a lot of flows into T-bills, a lot of flows into money market funds, that ultimately you could see the market trend higher going into year end.
So what about, from your point of view, Liz Ann, higher for longer? How much higher and how much longer?
So I think that, that's where the disconnect to some degree still exists in terms of market expectations. Yes, the market has pushed out rate cuts into 2024, but as of now, you're looking at 5 cuts being priced in. And under a scenario, even if we continue with disinflation, where you don't see the kind of cracks in the labor market that, not that the Fed is gunning for, but it's certainly in their forecasts. If the labor market stays tight and you don't see a hit to growth, it's hard to imagine what the scenario would be under which the Fed would see a green light for cutting rates versus just staying on hold. Now, you had Williams out, New York Fed President Williams out, talking about the relationship between inflation, if it continues to come down, and the fact that growth stays fairly strong and real rates start to rise. That could be a situation where the Fed says, okay, we're now getting more restrictive than we would like to be. But I still think that the bias by the Fed is to stay in pause mode until you get more of a crack in the economy, not just making a decision based on the trajectory of inflation.
Liz Ann, if not a crack, are we starting to see some, at least, a loosening of the labor market?
We are. The dip in the unemployment rate actually was because you did not see an increase in labor force participation. The payroll number was weaker than expected. That's the second month in a row. Full-time jobs actually declined by almost 600,000. That's as bad as we have seen since April of 2020. We all know what was going on there. We've seen the rollover in temporary help, the big compression down in hours worked. So you do need to peel the onion back a little bit to get a sense of where there are cracks in the labor market that could start to broaden out. And I think direction is always important. As I always say, better or worse matters more than good or bad. And it's that direction in payrolls that I think is worth watching. It doesn't tend to be the case that you go into negative territory in advance of recessions.
Where are we headed for the rest of the year, would you say, Chris, from what you see right now? We had a much better first half of the year than I think most people would have expected. Are we going to keep this up?
Well, I think the one thing that the first half of the year did teach us, and we talk about this all of the time, is just the dangers of market timing. And so we started out this year defensively positioned, and we were in the camp that we would see a recession within 2023. Obviously, the data is something that has proven really resilient. I think that would be the word of the first half of the year. We saw resiliency in terms of employment. We saw resiliency in terms of earnings. I think when you actually look through, though, the index doesn't tell the full story. And so the recession that a lot of people thought was going to occur, where did we see the recession? Maybe not in the economic data, but we saw it within earnings. So in Q4 of last year, you had 7 out of 11 sectors already in a profits recession. The same was true in Q1. And in Q2, it looks like 6 out of 11 sectors are going to be in a profits recession. So this concept of a rolling recession is something that we're seeing within the market, which really begs the case for diversification.
So, Liz Ann, you've talked on this program before about sort of a rolling recession. You've been talking about it for a while now, sector by sector, not overall for the economy, but sector by sector. Right. Are we seeing a version of that in the earnings right now? And let me ask you where you think we're going to end up. We have these ELVs, these equity analysts that we look at on Bloomberg, and I think they're still about 4,400 for the median for year end. Does that sound about right to you?
I don't forecast year-end price targets for the S&P. It's not something that we do. I'm just not sure it's a beneficial exercise for the benefit of what our client base is, which is individual investors. I will say, though, that the path up from here probably needs to see a stabilization in the E component of PE, because all of the gain in the market since October has been multiple expansion. You haven't had any contribution from earnings. And I think Kristin's absolutely right that you've got to look at the details of what's going on beyond the index level. That's important in terms of what the real story is that the market is telling about the macro picture. It's important in terms of valuation too, particularly the necessity of taking out the Magnificent Seven or the Great Eight or whatever fun words you want to use to describe what had been a very, very top-heavy market, at least into the beginning of June. And I think the sectoral or rolling recession thesis is likely to persist, at least in the near term. And to me, I think the best way to think about best case scenario is not soft landing versus recession, but a continuation of the roll through, whereby assuming we start to see services get hit, you've got offsetting stability and or maybe recovery in those segments of the economy that already had their recessions, like housing related, manufacturing, even some areas within the consumer goods side of the economy.
Okay, let me just ask one last question, Chris, of you. As thus far, the earnings are coming in better than was expected. How much of that's pricing power? How much of it is cutting costs? How much top line?
It is a great question, because I think what we've seen this quarter is when you look at the overall percentage of S&P 500 companies that are beating earnings expectations, it's north of 70%, with only 13% completely missing. But when you look at top line revenue, that's where we're starting to see the impact of disinflation. That's where we're seeing top line revenue really come down. So that's only 59% of companies are beating top line revenue estimates, while close to 22% are missing. And so this idea, what does that mean to me? That really means that we're in a slowing growth type environment. So soft landing, no landing, hard landing. What I do think is going into the second half of the year, I think earnings expectations are still a little high. I think we are going to see, in a higher interest rate environment, you are going to see continued pressure, the rolling recession that we discussed. But I think some of those expectations should probably come down for the second half.